I would just like to welcome you. So maybe just a brief introduction for those who are joining us for the first time and you're wondering what Invest in Africa it's all about. Invest in Africa is a Pan-African partnership initiative accelerating trade and investment by coordinating efforts across sectors to increase skills and impact, as well as replicability by working within that partnership context. And we are not a for-profit organization, and we include membership within our ecosystem, which have multinational companies, corporates, associations, financial institutions, coming together with the sole aim to create positive impact through job creation. Our vision is to create an Africa that is prosperous, and we aim to create about 250,000 jobs in the next 5 years as part of what we do. So far, we have about 1,000 SMEs who are part of our ecosystem, and we have supported about 80,300 jobs since we started, and unlocked financing for SMEs to the tune of 590 million worth of finance that has been facilitated. That amount is in USD. And we have unlocked Kenya shillings 300 million in terms of contracts that have been won through our online platform, Biashara.now. And so far, we've been able to train 2,000 SMEs. So that's a very brief introduction about Invest in Africa. More information can be obtained by engaging with our website, investinafrica.com. We'll be sharing that on the chat. About the program that we are currently running is to support SMEs to be resilient, but also to be able to come out of this pandemic period strong by having the right tools to engage post the pandemic period. So the program is run in partnership with MasterCard, and we have a very wonderful toolkit that you can be able to use for your business. We have the master classes that we've been running, which are tailored to the needs of the SMEs to build their recovery and resilience. And we've partnered with coaches who are also supporting the SMEs acquire the necessary skills to be able to work through the post-pandemic period. And we have a knowledge academy with useful tools that they can access and gain some best practice and guides for resources which they can leverage to enhance their knowledge and skill during this period. As well as we have a wide range of linkages through our financial partners to just support the SMEs to be able to access finance. And finally, we are matching SMEs through a B2B linkage platform where they can be able to not only learn from each other, but they're able to join mentorship cycles to enhance their networking. Our session today specifically speaks to budgeting. I know budgeting is an issue that we interact with at individual basis or at personal basis, but the context that we are addressing today is a context about our business. In other words, how are we planning our finances? How are we planning the resources that are around us for our business? And we are linking that to how we manage our cash flows. So the objectives of today's session is we will be able to understand what are the benefits or what are the importance of budgeting and cash flow management in our business. and also we'll get a glimpse on how we can create a budget and work with the right people. We use that budget as a tool to grow our businesses. Remember that a budget is a tool that guides our business in how we run the affairs of managing and apportioning the resources. So that's something that we aim to gain today. And lastly is to how to manage our cash flows, and we'll be getting some practical tips on how to fix cash flow problems, which has been something that we've struggled with in the circle of our business. So today we are once again joined by Frank Mwiti. If you have attended our sessions before, you have interacted with Frank Mwiti. He's been an invaluable resource to us on a range of areas where he's tackled, and today we're privileged to have him with us once again. Just a brief introduction of Frank. Frank Mwiti is the East Africa market leader for Y, and is based here in Nairobi with responsibilities of top-line growth of the firm across the advisory, transaction, assurance, and tax services. And he's in charge of the EY's investment plan and growth ambitions in the region. Frank brings on board many of experience. He has over 18 years of experience and strategy and governance, mergers and acquisition, and has been involved for both private sector and public sectors. And above all, Frank is very much interested on the growth of SMEs, and that's why he's here. He has previously worked in Kenya, in the UK, in the US, and has executive qualification in business strategies, artificial intelligence from reputable institutions that have worldwide acclaim. So without much ado, I would like to invite Frank Mwiti to take over the airwaves and unpack for us this topic on budgeting and managing our cash flow. So welcome, Frank, and take over.
Okay, perfect. Thanks. Thank you, Dennis, and good morning, everybody. Welcome again to this masterclass. I'm glad to be here as always, but even more importantly, I'm looking forward to an engaging session. As Dennis mentioned, this particular session will cover budgeting and cash flow management, and we will try and leave enough time for us to address any questions or points of clarifications that you might have. I'm quite keen to share some practical ways for SMEs to manage their budgets, understand the issues around cash flow and how to manage those, and hopefully that gives context on some of the areas where you can improve as a business. And maybe to start off is to share two quotes that I think are relevant to this conversation. On the left, we have a quote around budget. It says a budget is telling you your money where to go instead of wondering where it went. So the budgeting process enables you to be on top of the money that you have and some of the other resources you have for your business, but even more importantly, to have control on where that money goes. And similarly, on the right, we have a quote on cash flow management. You've all heard the phrase "cash is king." It is particularly more relevant now, given the market disruption and financial crisis that is unfolding on the back of the pandemic we are all going through. So the quote there helps emphasize that you could be making as much money that you think as you want, but actually, if you can't manage your cash flow, you will have a problem. And we will get into a bit more detail why that is the case. Is a concept called, for example, over trading, and also a difference between profit versus cash, and why those things are really important to understand and get your head around in order to manage your business better. From this session, I hope you will learn the following 6 things. You will get a better understanding of how to put together a better business budget. It will be hopefully a lot more clearer why profit does not equal good cash flow. Some of the main cash flow problems that businesses, particularly SMEs, go through or have to deal with. Strategies for managing cash flow, and also practical ways of calculating your solvency, liquidity, and the viability of your business, and some techniques on how to manage cash flow. I have intentionally gone overweight on cash flow management and slightly light on budgeting because I think if you get your head around cash flow management, budgeting more or less falls into place. And the crux of the matter is most businesses, particularly SMEs, fail not because it's no opportunity, not because the business is not viable, but because they ran out of cash. And running out of cash literally means your business has no blood. Cash is the blood for the business. So getting your head around your cash, how cash flow management works, how to manage cash flow rather, what are the signals that tell you you are going into a cash flow problem very early, would enable you to refocus your business, re-strategize, and more importantly, become resilient. It's an important point, and so hopefully this session will bring that out for you. So let's start off with budgeting. I imagine a lot of us already are familiar with what budget is about, but just for clarity, it's really an outline of expectations that a company wants to achieve in a particular period. Usually it's within a year, and the typical characteristics of budgeting include your estimation of revenues, so sales, your estimation of costs, expenses, the expected cash flows, and we'll talk about that because cash flows are both money coming in and money going out. Expected financing issues, so debt reduction. Do you need to use some of the cash, for example, to pay down your debt or to service your existing facilities? And then, of course, a comparison between how you're performing versus how you budgeted to perform. So what is the variance between you expected, for example, the first month to have sold 1 million shillings worth of goods? Have you sold more? Have you sold less? Where are you? And what do you do with that variance? Okay, positive variance, negative variance, depending on your performance. So these are really the characteristics of budgeting. And the budget can be very complicated or it can be fairly simple. The truth of the matter is, as long as it has the crux of the matter, so you know what the revenues are, what the expenses are, you have a sense of cash flows both in and out. You have obligations that you have to meet mandatorily and by contract, and you're on top of those, and then you track how you are performing against what you expected versus actual. This is really the essence of the budget. If you want to make it complicated, you can. I would not always recommend that you go too complicated. Start off easy, get the crux of the matter in place, and then it's easier to grow to become more complex after that. So why do we need to budget? Of course, a business needs to determine if they have enough money to fund their operations, to expand, to generate income. Okay, and that essentially is the essence of the budget. So you're either funding operations, by that it means you have salaries to pay, you have rent to pay, you have taxes to pay. You need to expand. You're either expanding existing business by maybe employing more people or opening new branches, buying more machinery, etc. Or you want to generate income. So for example, you're advertising, you're investing in new revenue streams or new products. All these are requirements for money, funds, and they need to be underpinned by a budget. So that's why ideally you need a budget. And without a budget, a company runs the risk of spending money it doesn't have, which happens a lot for SMEs, and I will point to why that happens. Not spending enough to compete. So holding back when in fact you should spend, and also failing to build resilience by having some emergency funds should things go out of kilter. You have some cushion. Okay, so 3 things: you're spending what you don't have. So without a budget, you don't know what you have and therefore what you can spend. Number 2, not knowing when to spend enough, either to defend an account, to get into a new market, or to acquire new customers, for example. And then number 3, cushioning yourself in the event that there is going to be hardship along the way. And COVID, as an example, has absolutely obliterated anyone who did not have a cushion, an emergency fund, or access to emergency funds. And the SMEs are particularly impacted. So hopefully this session will enable you to see things differently, arrange your matters differently, and prepare for eventualities such as this in the future. One of the ways, I will very quickly tell you, one of the ways to build an emergency fund, for example, is to have, if you have some spare cash, you can put them into what are called call accounts. Call accounts means it's some money that you put aside, it's earning some interest, but at any given time, if you need it, you can call it. Okay. The other option would be to invest, for example, if you have some spare cash, to invest in liquid, easily liquidated assets, for example, treasury bills. That would be a good example, or treasury bonds, so which you can sell very quickly, almost instantaneously, and get your cash back. And of course, the other option is to have standby facilities with banks. That means that at any given time, should anything happens, you can call on a credit line for 1 million shillings, 100,000, 500, whatever it is. Yeah. So these are some of the ways to build an emergency fund. There are SMEs that have not done that, and they're stuck with either they don't have liquidity, they don't have credit lines, or they have assets that are illiquid. So you have land. Selling land is either very difficult or takes too long. So you'll find it's not that you don't have assets, it's that they're illiquid, and therefore you are unable to access cash on the back of those assets. So that's just an example of how you can build a solid emergency fund. There's a difference between budgeting and forecasting. Okay, budgeting and financial forecasting. So financial forecasting typically will estimate the company's future financial outcomes by looking at historical data. So we say last year, for the last 5 years, we've been selling 10 million shillings worth of goods or services every month. We think if we continue on that trajectory, we will be selling 20 million every month by next year. So this is forecasting. You're looking at the previous historical performance, you adjust it for the realities of the future, and then you put a number on it. That is very different from budgeting. And unlike budgeting, financial forecast does not analyze the differences between actual versus budget, and typically it's regularly updated. You keep your forecasting regularly updated, simply because the circumstances of the market change. Competitors come into the market, new laws are put in place, people come up with new products and services, buying habits change. All these things mean very often you'll have to go in and change or revise your financial forecast. Unlike budgets, where typically budgets are fairly static, you have a sense of the money that you want to work with for the year, for example, and usually that is left as it is, and then you track it. Unlike forecasts, which are usually updated every 3 months, every quarter, something like that. And the key thing about financial forecasting is that depending on the results of the forecast, you have to take immediate action. You can't wait. Okay, this is very different from budget. Budgeting, you might say, by now we should have sold 10 million shillings worth of services or goods. We have only sold 7 million, and you say, you know what, we'll keep tracking and see what happens next month. That's very different from today. You had forecasted that you would have entered, let's say, and you would have launched a new product and gotten X sales. You are not there yet. What is happening? Have you not launched the product? Have you launched the product and pricing is wrong? You have to take immediate action fairly immediately. compared to differences in variances in budget. So just a point to note there that financial forecasting is very different from budgeting. You'll find a lot of budgeting is very, very holistic in the business. So you have all sorts of functions in the business coming together to create a final budget, and we'll come to the types of budgets that you need to be aware of, versus financial forecasting, which is a lot of times you find financial forecasting is particularly focused on the financial team, your accountant, your head of finance, your CFO, depending on how you're structured. But the key point is that there's some nuance difference, and it's important to not to confuse financial forecasting versus budgeting. There are different types of budgets: master, static, operating, and cash flow. I will very quickly touch on those so that you're familiar with them, and then it will be up to you to get a sense of which one is more suitable for you, given your business, the size of your business, your ambitions, and of course your existing arrangements. So a master budget, as I mentioned, there are 4 budget: master, static, operating, and cash flow. So I'll start with the master. So a master budget typically will focus the entire fiscal year, the entire financial year. It will include projections for items on the income statement, the balance sheet, and the cash flow statement. The income statement is also called the profit and loss statement. So it shows you essentially your bottom line. The balance sheet keeps record of your assets and liabilities, including your equity, and typically a balance sheet is prepared end of the year, but you can keep it updated as you go along, and it will hold the typical things in the balance sheet from an asset perspective. Would be things like your property, motor vehicles, any debt you have, any money that you're owed, so as receivables, any cash you have either in cash or holding it in the bank, and items like those. And then on the liability side of the balance sheet, you will have the typical stuff: money you've borrowed, shareholder equity, things that you say, for example, taxes that you owe, things like that. So a balance sheet really is a snapshot of assets minus liabilities. Typically, you see assets minus liabilities, you come back to the equity. And if we were to get deeper into that, it can also show how valuable your business really is. And then there is a cash flow statement, very, very key document. A lot of SMEs do not have cash flow statements, and it's a huge failure because, frankly speaking, today, when I work with the investors, both global investors and local investors that are looking to invest or buy businesses, typically they will start with looking at the cash flow, and then they will go to the income statement, the P&L, and then lastly the balance sheet. A lot of SMEs have a decent balance sheet, not very good income statement, terrible cash flow statements. And it's unfortunate because if investors are using that as a way to get a good understanding of how your business really is, where the cash comes from, where it goes, you too ought to be on top of it. So one of the things I would suggest to you after this session is look around, do research on what cash flow statements are about and what they are used for, what messages they carry, and more importantly, whether you have one. And if you don't have one, it's important you have one, you put one in place. If you have one, see whether it's something you can improve further on. Okay, and then the last thing in the master is the projections can include revenues, expenses, operating costs, sales, capital expenditures. Capital expenditures will be EV items on, for example, you're buying machinery, you're buying land, you're constructing warehouses. These are capital expenditures. Operating costs, as I said, are typical costs for running the business. Typically will be variable costs, for example, your salaries and your rent and all that. Okay, that's the master budget. So entire year projections covering all the 3 financial statements: income, balance sheet, and cash flow. Then there's a static budget. The static budget typically focuses on numbers that are based on planned outputs and inputs for each of the firm's divisions. They focus quite a lot on fixed expenses, which are not variable or dependent on productivity. And so, for example, rent could be a fixed cost. So whether you sell or not, you owe rent. A lot of salaries are also fixed. In other words, whether you do business or not, you have to pay your employees and such like. Yeah. So the static budget says what are those costs that, irrespective of whether I do any business this year, what am I working with? Yeah? What is that base? And can my business absorb it? That's really the point. And again, if you don't have a good understanding of your fixed expenses, as an example, that are not tied to how well your business does, it's likely that you might spend money you don't have, or not have a cushion to cover yourself. And then there is operating budget. These are typically, they include expenses and revenues generated on a day-to-day. So this is almost like a mirror or a contrast to the static budget. It will focus on expenses that you can control and that are tied to production. So, for example, raw materials, the cost of raw materials. Okay, so typically you find SMEs will buy raw materials because they have a sale, so they know that I am buying to produce to service this invoice or this purchase order, and so you have control over those costs. So depending on your projection on how you will perform month on month, then your operating budget also fluctuates in line with the business operations. Okay, so these are the sort of budget you can monitor much more closely, day by day, if need be, and more importantly, you can also reel back if you find that you're going over budget, if you think that might cause other cash flow issues, and we'll touch a bit on that. So the operating budget, for example, would not include items such as capital expenditures and long-term debt. Okay, so your operating budget, because we are saying it's variable and it's dependent on production, will not, for example, have items on machinery you're planning to buy, because that either you buy or you don't, it doesn't matter. Secondly, it will not include things like loans that you borrowed to pay over a long period of time, because usually the arrangement is you have to pay whether you produce anything or sell it or have any activity. They are not dependent on your production or your business activity. So again, operating budget, you need to know what is my operating budget, what is being driving it, how can I control it. That's very different from the static budget. And then lastly, there's a cash flow budget. Okay, and cash flow budgets help managers determine the amount of cash being generated by the company during a given period. So it will enable you to say, what are my inflows? Where is my money coming from? Cash coming from? Where is my money being spent? Because expenses need to be paid, etc. And then you have to have a good understanding on how long it takes for money to move around your business before it exits. So which is typically called a cash conversion cycle. But the key point is you would, for example, look at how you've been performing in the past, how your inflows have been coming in, cash going out over a period of time. Typically, people say 3 to 5 years. How have you been performing there? And then you say, how are you likely to perform going forward? Then you have a cash flow budget that you can now work with. Okay, and typically, the way you manage a cash flow budget, in case you're finding there is more outflows than inflows, is, for example, you apply for a working capital line of credit from our banks here, who will say, we will give you money based on the amounts that are owed to you by your customers. Okay, so that's a typical working capital type line of credit from a bank, which you can negotiate because it's simple. You go to the bank telling them the last 5 years or the last 3 years, this is the sort of business I do, this is the sort of invoices I generate, this is how long customers take to pay me. So actually, at any given time, I have, let's say, 20 million shillings that are owed to me by customers, okay, by my clients. So why don't you give me, let's say, 10 million shillings, and as these things get settled, I will pay you. And that is very specific. It's unsecured typically, and it's tagged to your accounts receivables in that case. So that's an example of how you can manage a cash flow budget. But ultimately, you would only do that because you understand what your inflows are and what your outflows are, and in between then you know how much cushion you need, and whether you have it internally or you need to go to a different source of cash, for example, credit from a bank. So I've talked about a master, static, operating, and cash flow budget. Depending on the nature of your business, you would at a minimum have a master budget. If you are an SME, I would absolutely encourage you to have a cash flow budget. The other ones on operating and static can be part and parcel of the master budget, depending on how granular you go. But please have a cash flow budget. Without cash, most SMEs fail because they run out of cash, not because the business is not viable. How do you do a budgeting process? Very quickly. To start off with, of course, you determine. You agree on the goals. You agree on what do you want to do this year. So this year you say, I want to grow my sales by 20% based on last year. I want to do that. I need to advertise more. I need to hire more salespeople. I need to invest in new machinery. I need to invest in training, whatever it is. You come up with goals that then, based on those, they drive what finance, what amount of money you need. Okay, based on the amount of money you need, let's say you say, you know what, in order to achieve these goals, I need 50 million shillings. Okay, then you say, yeah, I need 50 million shillings, so I'm going to budget for 50 million. In order to budget for 50 million, how much money do I already have? So you say, my bank accounts have 20 million, so you are short for 30. Then you say, on this 30, the business can itself generate another 10 as it is trading, because either you owed money or there's cash sales and all that stuff. So based on that, you have another deficit of, let's say, 10. So on that 10, you might then say, you know what, for this 10, what I'm going to do is I'm going to go to the bank and ask for 5 for now. And I'll be left with a shortfall of 5, which I will cover as we go along. Or if not, I might revise my budget, or I might borrow more. So the point is, you've come up with goals, you've first understood what is financial requirements there, you've tabulated all the expense, all the lines that require to be met, by when they need to be met. You look at internally at the resources you have. Depending on the resources you have, you know whether you need to go out external to borrow more money or to access more money, and that could be either inviting people to lend you money, or it could be inviting shareholders to invest in your business, whatever it is. You generate more cash, and that then enables you to then have a budget in place. You approve it, and then you monitor it. It's really that simple. It's nothing more complicated than that. What we find a lot with SMEs is that they do not go into the detail of how much cash they actually need to sustain the business for 12 months, as an example, for a year, and where is that cash coming from. And we also find a lot of the times, even when they are saying we have cash to manage the business and to grow it, they have not budgeted specific lines on where that money will be spent, and they don't even monitor whether the money is being spent in those lines and whether we are achieving what we said. Other thing we also notice a lot with SMEs is mixing personal money with business money. So you start saying, I have 10 million in my company's bank account, but I also have 5 million in my personal account, so actually I have 15 million. The reality of it is no. The business has 10. The 5 that you have is not company money. It should not be budgeted as part of this unless you're seeing it as a shareholder injection into the business. So I'm trying to say that separate the business, the cash for the business from the cash for your personal sources or needs. Do a budget that is very reflective of your business and your ambitions and your plans. Monitor it, and even more importantly, take action when their variances are material. So, for example, we recommend if you find your budget, you're going over budget by something like 7.5 to 10%, always do a corrective action. Very important. Okay, you might, if it goes 1%, 2%, you might not care, but typically you need to take action if the variance between what you planned versus what is actual goes above your planned number. That way you're able to either reduce other budget lines or get more sources of funding or plan better. Okay, very important. Now, the typical ways to have a better business budget are fairly common sense. So the first one is, when you're creating a budget, take into account the sector you're in. A lot of sectors have very specific budget requirements. If you're running, let's say, a logistics business, it goes without saying that there will be certain budget lines that are very specific to that sector. For example, your fuel consumption and how fuel fluctuates in the 12 months. The repairs and maintenance budget for a logistics business, accident and insurance, things like this. So take into account the sector you're in and the standards and expectations. So you're not taking a budget that is reflective of a hotel business, for example, and trying to make that work for a private school or a manufacturing SME business. Okay, so take into account your sector standards. That's important because it will enable you to also work with best practice for the sector your business is in. Number two, as I said, prepare something very detailed. The more the detail, the better for you to have oversight and control. And then it's always important to build some fat, build some slack in the budget initially, so that then you're able to either work within a margin. Of course, take into account whether there's opportunity to cut cost as you budget. So, for example, if there's opportunity to not spend on a certain budget line, then please take that into account, because you have control on cost cutting. Actually, use the budget as a way to reduce cost where required. And then I said you also need to look at your budget every so often. And of course, once you have a budget in place, you need to shop around for quality suppliers and service providers in order to help optimize your budget requirements. This is an example of a simple budget. I'll not go into a lot of detail, but it essentially shows income, it shows expenses, and both selling expenses and administrative expenses. It shows the actual that you're incurring, what you had budgeted, and whether you're over budget or under budget. And it can be more complicated than this. This is just a snapshot of a very simple budget. It can get more complicated than this, to the point where you can monitor specific cost lines, and you can monitor them by function, by person, by customer, all sorts of things. But the point is, you have what you started off with as budgeted, the middle line here, and then you have what you have actually incurring, and then of course is the variance. Are you over or under budget? And therefore, what corrective actions you need to make that happen. So that's budgeting. And as I said, I have intentionally, deliberately skewed these to focus more on cash flow management, which is where I think most SMEs really need help. And the more you understand and manage cash flow, the better your business gets, the more peaceful you sleep at night. Even more importantly, the more value you build in your business. Okay, so cash flow management, very important. So let me start off with really, what is cash flow? We probably already know, but cash flow has different facets. Ultimately, it's about the money coming in, the money going out, and therefore, what is it you need to do to either increase more money coming in, reduce money going out, and then of course use the money that you retain to grow the business. So on the left, you will have the business you're doing. So this is sales or revenue lines, how you're measuring your cash, the sort of rate of return you're getting on your cash sources. So for example, if you borrow a loan, if you get a loan at, so let's say 12%, are you able to put that money to work and still make a margin on top, so that your rate of return on borrowing at 12% is much higher, so you can pay the loan and still make a profit. So this is the ROI, the return on investment on whatever facility you have. And of course, what you do with the money. Once you have it, what do you do with it? And of course, how you account for it. But more simplistically, cash flow management is the process of monitoring, analyzing, and adjusting business cash flows. As I said, cash flows here means inflows and outflows. Why is it important? If you want to increase your sales, if you want to improve profit, then it's important to have robust cash flow management in place, and we'll touch on how you do that. And there are different techniques of managing cash flow, whether that's how you project your financials, how you develop budgets, how you reduce costs, how you track your receivables and expenses and credit lines. All these are techniques for cash flow management, and it's important to have those techniques very, very refined and honed out, because in the absence of that, you will be firefighting. Either you're running out of money, you're over trading, you can't meet orders, you're not paying employees on time, you're owed money that you have not collected, you have all these sort of problems. So you find that every day is a crisis. And typically the reason is a crisis from an SME perspective is because of lack of proper cash flow management. And there are other things that go with that, but cash flow management is one of the key points there. Now, a lot of times we see people confusing profit versus cash, and more importantly, not having clarity on what profit really is and what cash is, and whether say for example you have 50 million shillings in your bank account, whether in fact that is profit or it's just cash, and why you might even have 50 million in the bank account and you're still broke as far as a business is concerned. And part of the reason is that confusion between cash and profit. Let me just touch on two things. The first one is positive cash flow. By default, it means you have more money going into the business than the amount of cash leaving your business. How does money come into your business? It comes into your business primarily through sales, and once you do a sale, it will typically be a cash sale, so money in the bank fairly quickly, or it will be on credit. If you sell on credit, you generate an account receivable, so money that is owed to you by your customers, and as soon as you settle it, it means then it's transformed into cash into your business. Now, so primarily how money comes in, and money goes out by you're paying expenses, you owe people money that you need to pay, etc. So positive cash flow, more money is coming in than it's going out. And the flip side is true, i.e. negative cash flow is more money is leaving the business than is coming in. How do you fix negative cash flow, which is a pain point for most SMEs? And the short answer here is you start looking at your budget lines, start looking at your actuals, look at your variances, start cutting costs, or get better terms with your suppliers, as an example. So the key point is, do you already know whether your more cash is coming in than is going out? And I'm talking just cash, I'm not talking profit. Okay? And that really should also be reflective of what you had budgeted. Okay, because you must be spending what you have, not what you don't have, or you must spend what you can actually see. And we'll touch on some techniques around that. So why does profit not equal cash? So the thing is, even by looking at the profit and loss statement, which I told you is also called the income statement, you can't actually, in reality, get a grip on what your cash flow is. So if you take the income statement, the profit and loss statement, and you try to use it to decide whether your business is cash rich or not, you will get it absolutely wrong. And that's what even big business sometimes get wrong. Okay, and so it is not the P&L that you use to manage your cash, it's your cash flow statement. And when I say the cash flow statement, it's not your bank account either. Okay, your bank account is not reflective of your cash flow status, because your bank account will not have accounts receivables, it won't have accounts payables, and it won't have other nuances on the picture on cash that is required. So you need to really use a cash flow statement to manage the state of your cash. of the cash of the business, and to really get a sense of negative versus positive cash flow. Okay, how much stock you're holding, as an example. How much tax are you going to pay by the end of the year, which you haven't accounted for? What investments do you need to do from a capital perspective to grow your business? These things you can't use a bank statement to manage, because in all instances, bank statements are backward looking. It will be a snapshot at a point in time. You can't use your P&L, because your P&L also has estimates like depreciation and things like that. And in fact, it is historical. But even more importantly, it does not give you a sense of other non-P&L items like inventory and accounts payable. So again, profit is not equal cash. So by default, that tells you can't use the P&L to determine whether you are in good or bad cash flow position. You can't use your bank statement. That's just an input. It's a small segment of your cash flow statement. And you also can't just rely on just the balance sheet either. So again, as I said, you need to have a proper cash flow statement in order to have your head around the nature of the state of your business, but also to be able to monitor your budgeting. So hopefully that point is coming across. It's not your bank statement, it's not your income statement, it's your balance sheet, it's your cash flow statement. And that's an important point to please understand, because SMEs that don't fight crisis from crisis one to the other, they overborrow, they overleverage, they mix their personal finances with their company finances, they don't pay their people on time, they don't receive the money owed to them on time, etc. It becomes a mess. All right. Part of that discussion extends to you need to know when your business will become profitable if it is not. Okay, and because the reason for that is not because you necessarily will affect your cash flow. It's because profitability is a different concept from being cash flow positive. Okay, and profitability, for example, has implications on your tax. It has implications on your ability to borrow. It has implications on your ability to get a dividend as a shareholder. So these are different concepts from how you manage your cash. But this point called break-even point means at what point will your business become profitable? Because that changes the nature and the prospect for your business. You can't do that if you don't have a sense of what you need to measure. Okay. And of course, if you don't measure, you can't control. In other words, if you don't know when invoices are due, how much cash is tied up in your inventory, okay, how much cash is tied up in accounts in debts that have not been paid back to you, so accounts receivables, and how are you paying your suppliers, and can you do it differently so that you extract more cash from your supply cycle? All these things contribute to your cash flow, the nature of your cash flow, but they also have an implications later on whether you're profitable or not. Again, I'm just emphasizing, please get your head around the cash flow statement. It's an important point, and it will really, really enable you to control your business better, to grow it better, and to sleep well at night, if that is something that you would also want to have. Peace of mind, okay? So some of the cash flow problems really is, number one, a lot of businesses, whether SMEs or not, fail to plan for market volatility and changing conditions. So you assume how things went last year is the way they will go this year. Case in point 2020. You assume the fantastic quota of sales you had last quarter is what will replicate this year, this next quarter. You assume that you have control over interest rates and things like that. So failing to plan for this eventuality means you will either run out of cash or you'll be stuck with cash that can't move. Because also having too much cash is a problem, because it means you have an asset that you're not working. Okay. Then you also have a problem of tying up a lot of capital in stock and equipment. People buy a lot of stock, pay for it, sometimes even in cash, immediately, not on credit, but they can't move it. They don't have plans to move it, or they have plans to move it, but not the amount that they sold, they bought. Okay, so you have cash that's tied up in stock. A lot of SMEs, for example, SMEs in the pharmaceutical space, stuck with inventory that can't move, and these are very expensive inventory. So you have a problem with how you estimate your demand and how you drive your sales. So you overstock, and sometimes you also you spend a lot of money buying equipment. One of the things that you'll see if you travel outside Africa is a lot of SMEs, for example, in Europe, have perfected how to only buy what they have orders for or what they can sell. So they've done proper demand planning. And then for equipment, instead of buying equipment, they get into leasing arrangements, if you've heard of that, where you lease equipment. So you're not having to pay 10 million for a machine. You just pay, every month you pay 100,000 as an example. So these are some of the ways of releasing cash out of your stock and equipment, as an example. Then you also have instances where you end up buying long-term assets that are really very illiquid. Investing in land that probably sometimes is not relevant or required, and so you have an asset that is illiquid. Even when you go look for a facility from a bank and you tender the title for that land for some cash, usually it's a very protracted process. It's not even the valuations are very depressed, etc. The point is that you need to be sitting back and say, how does this business grow year on year? What really do I need to invest in long term? Is it machinery? Is it land? Is it buildings? Or can I remove all these things and become just pure variable cost that I can control? And therefore you release more cash to put into other parts of growing the business. Then you have issues of collecting accounts receivable slowly. Collecting accounts receivables too slowly, so money that is owed to you, that should be paid 15 days after delivery, it goes on to 20 days, a year, and things like that. And of course, is the concept of overtrading. This overtrading is where you're taking orders and servicing them, but you're not necessarily well equipped to collect the cash. You're not also well equipped to produce and manufacture and supply in line with the demand from your customer. So you end up tying more cash faster and faster in your business, while taking more and more orders from your customers. So you find a lot of SMEs, either because they think that's the best way to grow the business, they generate a lot of orders, but they can't actually fulfill them. They can't fulfill them on time. They can't fulfill them fully, and more sometimes they have very protracted and difficult conversations with clients. And the reason is that's symptomatic of overtrading, where you have not learned to say no, or you've not learned to plan to focus your demand on the customer side. And what that does is, as you receive more orders, you order more stock or more inventory, or you employ more people. But the truth is, the order does not translate into cash quick enough for you to actually cycle back and pay for your inventory, pay for your workers and all that. So you get stuck in a cycle that is very difficult to come out of. And that's called overtrading. So learning how to say no, you will see it in another slide as we go along. Some of the cash flow drivers will be revenue growth, where you're focusing on new customers, you're focusing on new products, you're focusing on selling to returning customers to drive volumes. And of course, you can also put in price as a lever to increase your cash. So something that you were selling last year for 10,000 shillings, you adjust it, for example, for inflation, you are now selling it for 11,000 or 12,000. So that 2,000 difference goes into increasing your cash flow, assuming, of course, that you're managing your cash collection properly, etc. And of course, volume means you're selling more of the same or of a different item. Then there's operating margin. Operating margin touches on two things. It touches on cost of goods sold. That's what COGS means, cost of goods sold, and it's also focusing on selling and advertising. So operating, selling and the administrative expenses. So operating margin, we are saying if you go to the market, as an example, let's just assume you are buying and selling. You go to the market and you buy this for 5,000 shillings, and you incur certain cost before you sell it for 10,000 shillings to the eventual customer. That difference between what you sold for 10,000 versus the cost of buying and putting a bit of your value into it, or 5,000. That difference of 5,000 is really the cost of goods. The 5,000 is the cost of goods, and the difference between 10 and 5,000 is the gross profit. Now, the way to improve your cost of goods and therefore the way to reduce your cost of goods and therefore improve your operating margin is get better deals with your suppliers, for example. Ensuring that there's not a lot of stuff that's being returned after you've sold it. Okay, improving your operational efficiency so for example, through automation and things like that. The point is there's a lever within the operating margin that you can use to increase your cash flow. Similarly, in the administrative and selling expenses, you can look at how can I reduce my shipping cost? How can I reduce my marketing budget? How can I reduce my payroll? Because these are the administrative expenses that consume part of the gross profit that would otherwise have been available for you to enjoy as part of your liquidity pot. The other one is capital efficiency. So how well are you using your existing capital? So either it is buying plant, property and equipment, PPE, so things like land, buildings, machinery, or buying inventory. Can you, for example, buy more efficiently? Can you sell quicker? Can you only order your inventory when you have a purchase order on the other side, so that you're not having a lot of inventory sitting in your warehouses and these sort of things? So the point is, cash flow, you can see at it from top line revenue growth. How can I improve more of the sales so that I generate more, for example, more cash sales? Maybe you might say, instead of selling on credit, you're going to give somebody discount so that when I sell them if they buy cash, if they pay cash, you're going to give them a discount. So you're encouraging more cash sales to improve your cash flow. Why is that important? It may be if you sell on credit, even if the price is higher, it takes too long to get paid, and so you will either be servicing loans or you will be delaying payments, etc. So it may well be that price and discounting could be the way to move from credit sales to cash sales. And similarly, for returning customers, you might say, if you come back to me, I will give you a better price because you have been ordering with us for long. And the reason I give you a better price is because it costs me less to advertise to you. Okay, so these are different ways of improving your cash flow. Okay, one of the other things that's important to understand is the working capital cycle, because particularly if you are in the manufacturing space, because the working capital cycle is very, very tied to your cash flow and your cash flow management, and it also impacts your negative and positive cash flow status. So typically you will receive a purchase order. On the back of the purchase order, you will buy inventory, so raw materials. I'm assuming we're talking about a manufacturing business here, and then that raw material is sitting in your warehouse or in your production lines as a work in progress. Okay, and then you will of course input other production resources. For example, you might use electricity, you might use whatever else, and then you translate raw material into a finished good, an actual finished good that's available for sale. And at that point, you hopefully receive an order, and in which case then you distribute that item, you put it in a lorry or something to take it, transit, etc. And after which, now two things happen: either you sell it on cash or you sell it on credit. If you sell it on cash, we are good, money in the bank, happy days. If you sell it on credit, you have a receivable. that is money that is owed to you. Now, at that point, the most important thing to do is to keep your eye on how quickly you collect your debt. Why? Because, of course, it means you potentially are in a negative cash flow position. There are two ways to speed that up. Number one, you can give a discount on, you can give a credit or reduce the amount owed if you are paid quicker, or you can even sell the debt at a discount. So let's say you sold me goods, I owe you 10 million shillings. You can take that amount that I owe you. You go to a bank or some of these other alternative financials and say, this guy owes me 10 million. Give me 9.5 million. When he's ready to pay, he will pay you 10. So that person makes 500,000 on top. Okay, that's working capital financing. But the point is that this is the cycle. The key thing is to make sure that this cycle is as tight as possible. So, for example, the duration between receiving your purchase order and getting it out to the customer, the shorter it is, the quicker it is likely that you will get paid and rinse and repeat. Okay, and then of course the other key thing here is to manage your receivable cycle. In other words, make sure you're getting paid as quickly as possible. Usually prefer cash. Typically we say if you can have your business doing 80 to 70% of your sales in cash and the remaining in credit, then I think you're in a good place. Cash flow management wise. Some ways to manage cash, some techniques for cash flow management. I've already talked about accelerating how you collect your accounts receivables. It's important, I cannot emphasize enough, to stay on top of your accounts receivables. Most SMEs go bust because they are owed money by customers and they are not collecting it enough, or they have sold on credit when they shouldn't have, because they didn't realize the person or the business they are selling to cannot actually pay them. Then you need to stretch your accounts payable. In other words, you need to say, anytime I owe somebody, can I get better terms? So let's say I'm buying raw materials, the supplier, instead of giving me 30 days, can I get 45 days? Can I get 60 days? Can I get longer terms? So you're stretching accounts receivable. And one of the other ways to stretch your accounts receivable is you do not prepay for things. As much as you can, you don't prepay for things. Okay? And then of course there's reducing your cost. I've talked about regularly monitoring your cash flow, using your banking services wisely. Most SMEs don't. You have SMEs running to banks and asking for loans based on title deeds and things like this, when in fact they could have gotten unsecured loans, they could have gotten working capital financing, they could have gotten their trade finance, import finance sorted out, they could have gotten other leasing arrangements, leasing solutions, all these sort of financial services that are available. So take your time to first understand your business, get a view on where it's going, where you want to take it. On the back of that, it's easier to have conversations with suppliers, it's easier to have conversations with customers, your employees, and of course your bank, and other capital providers, including your fellow shareholders. Okay. In the absence of that, as I said, what typically happens is you will be firefighting. It will be crisis after crisis and stress after stress, because you feel like the business is in charge of you instead of you in charge of the business. So that you're the one directing where money should be spent from the business. You're the one directing how it should be spent, how much of it to spend, how much of it not to spend. You can't do that unless you take your time to understand your business, manage its cash, understand its cash flow position, its cash flow requirements, understand how the other costs fit in, how clients fit in, how your employees fit in, how your bank fits in, how your own sources fit in, why it's separate from your private business, and of course put structure around that. Technology is a good thing for SMEs to use. In fact, this is the one big thing that can change the dynamic for you if you embrace technology. How you do your bookkeeping is technology enabled. How you monitor your business is technology enabled. How you interact with your customers is technology enabled. How you monitor your key performance indicators for the business is technology. How you advertise is technology enabled. These things will make a huge difference. The difference between running a business that does not embrace technology and one that does is one, it's more heavy lifting for you. It's difficult to get timely management information to see where the business is and where the status of it. So you don't have automated reports. You don't know how you are performing on sales and all these sort of things. So please embrace technology. It's the swiftest way for an SME to accelerate your growth and to also stay on top of it. Invest in it. You see the return on investment on the investment of technology fairly quickly. Two last slides very quickly, then you can have questions. Some strategies on managing cash flow. I have emphasized the point that don't work with possible cash, work with real cash. The only money you have to spend is real cash, which is in your bank account, for example, or if you're holding it in cash, it's cash. It's not future sales. It's not accounts receivable. It's not signed contracts or handshake agreements. It's real money where you have visibility on it. That's what you first plan with. It's good to dream, but look, start with the reality of it. So very important. And you find a lot of businesses, and I will be open and say, for example, a lot of Asian SMEs are very good at that. They work with what they have, not what potentially they could have, and you can actually see that robustness coming through as they grow the business. Understand the financials. I can't stress that enough. You need to keep track of your cash flow. That's a fundamental point. It is critical, and you need to understand the financials that matter for your business, where your accounts receivables are, where your accounts payables are, how you're trading based on budget versus actual, what the variances are, why there are variances, do they need you to act on them? Those sort of things, very important. Okay, set up credit before you need it. I've said that at the beginning of the session. I'm emphasizing it again. Please do not wait until there's a crisis for you to figure out whether you can access credit. Okay, every business, big or small, requires credit, more or less, to grow. 99.99%. Prepare, have it in place, so that when time comes, you're not running around looking for loans and trying to beg banks to give you money or your friends to invest in your business. Sit, plan, set up credit before you need it. You will not have cash flow crisis when time comes. The cost of having a credit facility or an ability to get credit ready and available at any given time enables you to focus on growing the business and managing it better and embracing technology and all these other things, rather than firefighting. Okay, then absolutely learn to say no. Not every sale is worth making. Sales do not always equal to profit. Number one, they do not always equal into cash. Okay, you would rather understand what the opportunity is and learn to say no. Once you learn to say no with time, you will have more yeses that matter. So not every sale is worth making. Why is that number 4 important? Because that is usually the cause of overtrading for SMEs. They overtrade. You accept every sale, you chase every sale, but actually the truth is either they are not profitable, it's a waste of time. You could have made a better sale somewhere else. You could have focused more on existing customers and generate sales that make sense. And more importantly, it does not decrease your cash flow. So please learn to say no. These are practical things, Work with real cash, understand your financials, set up credit before you need it, learn to say no. If you do those 4 things, you're already 80% are on the way to having a perfect cash flow management situation. There are certain cash flow ratios that are important to be aware of. I will not get technical around it, but please be aware of them. I emphasize the need to have a cash flow statement, okay, and I emphasize the cash flow is the driving force behind the business. There are certain cash flow ratios that are important. Big business, small business, you have to have an eye on them at any given time, even as we speak. If you're running a serious business or an SME that is up and coming. The first one is current liability coverage ratio, which demonstrates the ability for operations to generate cash that can be used to cover debts that need to be paid within a year time. In other words, you need to be able to say, I have a way of measuring how much cash my business is generating so that I can pay any liability that are due. For example, debt. Okay, And there's a way to actually calculate that. Okay, I've given the ratio there. I'll share this later after. But the key point is, if you don't know what your current liability coverage ratio is, you'll be firefighting. Guaranteed, you'll be firefighting. And more importantly, you will also be overtrading in all likelihood. So, current liability coverage ratio. Number 2 is the cash flow margin ratio. Okay. Now, this enables you to express how much cash is generated by the business from the operations versus the sales that you're making. Okay, so it indicates the amount of cash generated for every dollar of net sale. Okay, and the larger the percentage, the better the firm is at converting sales into cash flow. In other words, how many of your sales are converting into actual cash? Okay, now the higher the better. Why? Because it means you're number one, you don't have a lot of accounts out there. In other words, people owing you money. You're not selling too much on credit, but even more importantly, you're in all likelihood positive cash flow. This is an important ratio because a lot of banks look at this and they use this to give us a better sense of whether you are really, are you just selling things on credit and you're stuck, you're not collecting enough, and therefore you're borrowing money, which will in all likelihood go down the toilet as well, because you might borrow money to generate more cash, more sales that you are on credit. So you end up not being able to service loans, not being able to cover your operating expenses, but even more importantly, the business wouldn't grow. The last one is the cash flow coverage ratio. So the one before was cash flow margin ratio. This is cash flow coverage ratio that takes the cash flow from operations divided by debt. It's a measure of solvency. So solvency, maybe I should explain. There's a difference between being solvent and being liquid. Eh? So solvency is about, can you pay your long-term debts as they become due? Okay, so you can hear, you sometimes hear businesses have become insolvent. So they are not bankrupt, they are insolvent. In other words, they cannot meet the long-term debts as they fall due. It does not mean the business is not viable. It does not mean it's bankrupt. It's just that it's insolvent. It is not generating enough cash from its operations to pay its debts. That's very different from bankrupt, which is you're done. Your value of your liabilities are way higher than your assets. Even if we were to sell your assets, you can't really pay your debts, blah blah blah. Anyway, the point is, this is about solvency, not liquidity. So liquidity is, do you have enough liquid cash happening to run your operations? Not to meet external facilities, but to run your operations. Are you liquid? If today I tell you you need to buy stock to supply this, to meet this order, do you have cash? Do you have cash to actually do that? That's liquidity. And there are some loans, there are some expenses that are due tomorrow or payroll that's due end of the month. Can you pay? That's liquidity. Versus you have loans that you borrowed that are due to be serviced every quarter for the next 10 years. Are you generating enough cash to pay? Are you solvent? Now this ratio here, cash flow coverage ratio, measures the solvency of a company. It demonstrates the ability of the company to use its operating cash flows to pay off its debts. The higher the better. It means you have more cash left over after paying debts to fund your operations. Okay. For SMEs, it's important that you're on top of some of these ratios, and you can read a bit more. I'll share this slide, but you can read a bit more, watch some YouTube videos, etc., to give you a sense, if you already don't, to give you a sense of those ratios. Most SMEs, it's very easy to generate that. If I were you, every morning I wake up, I would look at those and see whether you are staying within a certain parameter. It will already give you a good sense of control on your business. Okay, so those are the 3 ratios. There are many other ratios, but those are 3 that are important for you. Cash flow management really can be very simple if you use just 4 things. You need to improve your cash collection. You need to forecast regularly. Okay, you need to analyze your expenditure and get your head around the drivers behind each of your expense lines, and then push to always have better payment terms, both in 2 ways: payment to your suppliers, the longer the better, and payment collection from your customers, the shorter the better. Okay, so keep it simple. Today, if you, after this meeting, if you went and sat with your team and said, How can we improve our cash collection? First of all, where are we at? Who owes us money? How can we improve it? Number two, how can we focus this thing better and we stay on top of it? How can we analyze our expenditure and see where is our money going, and how can we manage it better, tighter, more timely? And then how can we extend our payment terms to suppliers? How can we shorten our payment term, our collection from clients? You will already be getting your head around your cash flow management. And then you say, there are those three ratios I've mentioned. Where are we with them? How do we track them? Who's going to give you the right information every day so that you know where you are with those? That's it. You really, this is it. There's no bigger science, rocket science beyond this. It can get more granular, but that's really the crux of the matter. I'll finish by mentioning what I always mention in this masterclass is that as EY, we have what we call the 7 drivers of growth. The 7 drivers of growth is a framework and a tool that we use to help businesses, both big and small, to drive the growth of their business. It's 7 drivers, starting from people all the way to risk, as you can see there. And more importantly, they enable you to have a practical roadmap of moving from where you are to where you should be, with specific detailed things that you need to do. If today you mark yourself as, using the tool, you mark yourself as, this is where I am on my finance, this is where companies like you that are leading in the market are, this is where you aspire to be, either there where everyone is or somewhere else, then we give you the tool that tells you this is what you need to do to improve and to therefore enable you to transform your business, accelerate your growth, become more resilient, and of course move up the chain if that is your ambition. I will stop there. We still have 7 minutes, and I will give it back to Dennis for any questions I'm happy to clarify. Thank you.
Wow, thank you, Frank. That's been quite amazing, and I could see the struggle in terms of trying to manage the content within the time. I think this has been quite insightful. The highlight for me personally has been the difference between solvency and liquidity. So those are something that I've always used ignorantly, but today I live with a very clear insight of what they are. So I just want to know if there is a question. I'll give at least 2 to 3 questions, then we can bring this to a close. We have about 7 minutes to end. So there's a question, one from Diana. It says that she's in the service industry and real estate. Most of our suppliers and clients are paid within 30 days. My business partner wants us to hold for 90 days, but I do not like those persistent phone calls, so I authorize. What will be your advice? This is a more personal question, so Frank could take it.
Sure. Thanks for that question, Dan. I think if I understood you right, there's a dynamic you would have to deal with there. My first point would be that it's important for you to take your time to articulate the nature of your business to both your people internally, but even your clients. Clients, surprise, are very, very accommodating once they understand how your business really works, and even more importantly, how your cash conversion cycle works, because they also are actually having to deal with almost similar challenges. My first point would be, first, get a sense of your conversion cycle within your business. Work with your suppliers or your partners, as you mentioned, to articulate that better to your suppliers. You can then arrive at a meeting point that enables you to not have very extended credit terms if I've got you right, and even more importantly, get a better understanding of whether you need to really be supplying that customer differently or probably not at all. You remember I mentioned that you also need to learn to say no. But I would say that start off with articulating how your business works and your cash conversion cycle to your customers. In fact, just earlier this year we did some, as EY, we did some piece of work for a certain bank, and part of what we were able to do with their customers in the manufacturing space is to help them also get their head around their cash conversion cycle, and on the back of that to then see how to better service their banking facilities, but also how to better service their customers. Now, a lot of those customers are service customers, so they're in the services business. So I am talking practically. In other words, having a conversation first internally to understand the cash conversion cycle, so that your own partners know why your view is we should have shorter payment terms with our customers, and then on the back of that, then have a conversation with your customer on this is how our conversion cycle works. This is why it's important for us to maybe have different payment terms. I should mention, Dennis, I have a hard stop at 12:30 because I have a meeting. But yeah, I'm happy to take one or two other questions, please. Hopefully, Diana, I've responded to your point.
Thank you, Frank, for that elaborate response. And I'm sure Diana is very happy about it. We have shared Frank Mwite's contact. We've beamed it on the screen. You could see it. Perhaps you may want to contact him directly to support you in one of the areas. I'm seeing a question here also. They're saying we are in an industrial engineering sector and we have tried to improve our debt collection by coming up with the 50 advance and the 50 completion policy. We are still having challenges in collecting as clients come up with excuses that still delay the process. Any advice on this? I think that will be our last question for the day.
Right. I think it still resonates with the previous my previous response. There's of course emergency measures. Like for example, I did mention that there is a market already for selling accounts receivables. In other words, if you have clients that owe you money and you have those invoices, actually there is facilities both from banks as well as other alternative lenders to buy your invoices at a discount, of course. So if you're owed 100 shillings, they are happy to give you, let's say, 90 shillings, and they take they do the trouble of collecting the 100. Obviously, there's a flip side to that, which is that you can also mess up your client relationship if you send your receivables without them necessarily understanding your circumstances, or indeed depending on who you sell it to. So there's that emergency measure. There's the second bit of it which I mentioned to you, which was you can actually negotiate a discounted payment. So you go to the client. Actually, we've done that for a number of manufacturing businesses as well on the back of COVID, where you come up with a payment plan, a very clear one. You sit with the customers that owe the money, and you come up with a plan that enables them to pay over time, depending on their circumstances, of course. But even more importantly, I think it's what I said earlier about saying no. You know, it's not every sale that's worth it. The effort of collecting, of chasing up, of all these things actually detracts you from doing better deals with better customers. So sometimes we are so busy looking at just the sale, we forget about the additional overhead and the attention that is pulled away from managing the normal business. So I would say, one, consider a payment plan. Of course, revise your conversations with your clients on your payment terms. It's possible to sell your accounts receivables, but do that very carefully. And then number four, of course, is are those the sort of clients you want to be dealing with, or can you repivot to do something different? Without understanding exactly the nature of your business, I probably cannot give more specific advice, but happy to support in post the call.
Yeah, thank you very much, Frank, for making time to be with us today and to take us through that wonderful topic on the budgeting and maximizing cash flow. One of the things that Frank has said today, which I think I will emphasize, is that do not wait for crisis to look for your credit, prepare for it. So maybe that's something that resonated very well with me, and I think I will also just emphasize it. Another thing that has been a highlight for me is that do not confuse the profits you're making with cash flow. Most of the time we've done that, but I think now we have a better perspective on how that is supposed to happen and what it means to our business. So without much ado, I want to thank you so much for creating time to be with us on this session, and this conversation continues. Do not hesitate to engage with us online or in any way you're able, and look forward for other exciting sessions that are coming under the Masterclass series.